Hello, everybody. Uh-oh. We're live. Oh, can you turn on the lights, son? Forgot to turn on the lights. Oh, here we go. There we are. We're not in the dark. Come on over here. Introducing Mason, fifth grader. How are you doing, Mason?
Good.
Good. What are you up to this weekend?
I don't know.
I think you have a run tomorrow.
Oh, I do have a run tomorrow.
Yeah, tomorrow at Riley. Pretty fun. Anyway, yes, good stuff. Can you do me a favor? Can you hand me my phone? Just in case we have any kind of technological glitches. Thank you so much. We're going to have a fantastic weekend. What's that? Yeah. Oh, yeah. Oh, yes. We have, he now does running. That's his big thing. He's on a track team, right?
Yeah.
Pretty fun. Pretty outstanding. Right here, bud. That's what mommy and daddy did, track. And daddy did cross country. Mommy also did soccer and volleyball. She was a major athlete. Anyhow, let's go ahead and get this party going. And without further ado, let's start this housing debrief. This is episode 1 of season 3. And I'm pretty excited. Pretty excited that we're doing this again. It's been a while. Been a little bit of there's been a lot going on, so it's time to catch up. And first, I wanted to go over the fact that we have a company. It's called Reports on Housing. It's your local real estate snapshot. It's about delivering real, honest to goodness facts, statistics, uh, everything you need to know about the housing market. And I'll let people know if I really think that things are about to tank or crash or cracks in the market. Don't see any of that at all in the numbers. I want to start off with that right away. And people think because I'm a real estate housing analyst that I'm automatically skewed towards everything being rosy and positive, but that's not the case. I am a quantitative economics and decision sciences major. I am a geek. I'm a housing analyst. I geek out on it. There's been so much going on in the economy so far this year that it's been like a Super Bowl for me every single day, and it's been absolutely outstanding. We have reports that dot all over Southern California, and we're going to be looking at expanding to the Bay Area later on this year, and then at the very beginning of next year, we will go into the Maricopa County, Phoenix area, as well as into Vegas, so Clark County. So we're in the midst of expanding, and I actually have the numbers for those various areas. We just need a whole year's worth of numbers before we can launch. So the most recent report that came out, by the way, is called Going, Going, Gone. This was the one that came out along the coast. That's along San Diego, Orange County, and Los Angeles counties. They got theirs this week, and San Bernardino, Riverside will get theirs this coming up Monday. And there's something else that I want everybody to do is smash the like button. I want to get this out there, and the best way to do that is to travel from Facebook over to YouTube at Reports on Housing is our handle on YouTube. You can just search up Reports on Housing. We'll come up. Subscribe, like our videos, and subscribe. And the reason I'm asking you to do that is so that we can get the word out there, so that people can follow a housing analyst, so that they're not stuck following somebody that is just putting out a lot of misinformation, because there's plenty of it that's out there. So first, I want to also start off with something funny. Of course, this is just a couple things. That's how I am. This is how I operate. I'm all about kids. I'm all about laughs and economics. It's the family economics and the children, all that good stuff. But here's some funny stuff. Teams meeting audio only and Teams meeting with video. And I'm sure we all can relate at this point. Anxious like everybody else is to get off of Teams and Zoom and all that stuff. Parents are not home inspectors. I love this. Probably everybody should protest this when parents show up and they are going to help their kids inspect the home. They should get a professional inspector, not mom and dad, to help out in the inspection. We've all seen how that goes in the past. So gets us to our episode of rising rates versus hot housing. We're going to get right into it, because there's been rising rates and there's been a lot going on. This is the Freddie Mac primary mortgage market survey. Some lenders go, man, this is a little bit low. That's because it is 1 point and 20% down. That's because it goes back 51 years. Back in the day, you had to put 20% down. You don't have to anymore. You can get an FHA loan at 3.5%. You get everything in between. So, and prior to there was a lot of zero down loans back in the day. Those don't really exist as much today, but you had to put 20% down and 1 point. And this is what 20% down, 1 point looks like today. It's all the way at, oh, by the way, COVID-19, this is where it started. It's at 3.69%. On the right-hand side, you can see we went up quite a bit. And this is from December 23rd. In 4 weeks, we went up 0.5%, and then it was flat, and then we went up again. And I'll explain what's going on. But the last time we were this high was in January of 2020, and that was the numbers as of Thursday. But a lot has happened even since Thursday, because that is like a week's long survey that's done. This next survey is going to be even higher. We're at least at probably, it's going to be close to like 3.8. I think that's where it's going to come in next Thursday. So we'll just have to stay tuned and see. But people are wondering, what is going on with rates, and why all of a sudden this big gigantic shift? Why at the beginning of this year did we all of a sudden change gears and something major took place? And let's get into that. So basically, there's quite a bit of inflation. So far, there's been in the inflation has been a big piece of the overall picture. And there also was Omicron. So we had inflation, and that kind of did something with rates. Then we had Omicron. That did something that was the opposite of the direction that rates were going. So there was this tug of war between inflation and Omicron. And then there's the Fed. And the Fed is what we've all been absorbing since the very first day of this year. So basically, this is the 10-year treasuries. And there's a stickiness between the 10-year treasuries and 30-year mortgage rates, which is why we follow this. Pretty much it's the 10-year treasury. When the 10-year treasury rises, mortgage rates typically rise. When the 10-year treasury falls, mortgage rates typically fall. So here's what has happened so far this year. Let me get back to, there we go. So this is at the beginning of last year. We went from 2.65%. That was after 17 record lows. The 17th was the first week of January 2021. We're at 2.65%. Then we watched 10-year treasury rise as well as 30-year mortgage rates rise. And it went all the way up to 3.18%. That's where the top of this green line is. Then I was actually really happy. I wanted rates to rise because that would give us more inventory and it would slow down this market. And then we've sped this whole entire time. So people go, Stephen, why are you rooting for rates? It's not that I want rates to rise because it hurts buyers and it would hurt the real estate market. What I really want is just to slow down the velocity of this market and add more inventory. And because it's been taking so long, the inventory has just been getting lower and lower and lower. And that's why I was rooting for it as early as the beginning of last year. And it did not happen. So what ended up happening, it got up 3.18%, then the 10-year treasury dropped, and so did 30-year mortgage rates. And we got down to 2.77% by the time we got to August, so very close to our all-time low. And then it began to increase a little bit. I was happy that it was increasing, but it just wasn't enough. And then after that, we went up and down, up and down, up and down. And this was when Omicron, we were coming out of Delta, went into Omicron, and then we were dealing with inflation in Omicron. So we were getting a mixed bag of news. Omicron was bringing rates down, and inflation was bringing rates up. And then we had this from December 23rd. For the first 4 weeks, we went up 0.5%. And then it went flat for a couple of weeks. And then all of a sudden, we got this big, gigantic spike. That spike had two things involved in it. Number one was last Friday, we had a very hot jobs report, and it was beating everybody's expectation. That was number one. And number two, the second thing that made this thing elevate even further this week was inflation. Inflation came in a lot higher than what they had anticipated as well. So it beat projections, and you don't want inflation beating projections. That's for darn sure. So that's what's gone on so far. So inflation is real. And the Federal Reserve has talked about how it's not transitory, and this was as of the end of November. Right around Thanksgiving, they started changing their tune, and then they met in December, and they made a big, gigantic shift, because this is what came out this last week. We had this week is we have 7.5% inflation rate, and if you go back, if you drill back down to core, we're at 4.5. I believe that's where it's at. It's right around there, 5.5. It's way too hot. It's just they want to be at 2. It's more than double where they like to be, so it's coming in extremely hot. And uh, then we're getting a lot of articles that we're starting to see out there, like for example, this one from USA Today is it's a wage price spiral with all this inflation. So what that means is that, oh my gosh, wages have been going up, but is that causing the cost of goods to be higher? So then in turn, they're going to have to raise wages up even more. So it's this big spiral. And this is what led to a lot of the 70s inflation that we had, and this is what the big concern is. However, this is why the Federal Reserve is acting the way they're acting right now. So, despite higher wages, inflation gave the average worker a 2.4% pay cut last year. So, if you factor in inflation, they actually are making less right now because their dollars aren't going as far. And then the Wall Street Journal is, as inflation soars, central banks scramble to lift rates. So central banks around the world are rising rates. UK already rose theirs. We're going to be next month. Why we are waiting is I have no idea. Back in the day, the Federal Reserve in between meetings would raise the rate. It didn't really matter that you had to wait till a certain time to do things, but it's a lot more orchestrated right now. And I really wish that they would actually pull the trigger right now and stop playing around in mortgage-backed security land and all that good stuff. But the Federal Reserve has been behind the 8 ball. So they admitted that it's no longer transitory, and now they're behind the 8 ball because inflation really has been kind of out of hand. So what's going on now is we have a hurry up offense. The Federal Reserve is doing this hurry up offense just in time for the Super Bowl, right? Great analogy, but this really is what's happening. This is where you're behind the 8 ball. So what do? You start doing everything you can to try to score and win, and they want to tamp down inflation. But the only way that they can really do that is because they should have been acting before, is by enacting a whole bunch up front. They have done nothing so far except for bringing back the MBS, their mortgage-backed security purchases, down to zero, which they started last year. But they've done nothing else beyond that. They're waiting until next month to even start. And my thinking is they should have already started. So pretty much all the financial institutions, everybody, and all the investors out there, they've pretty much digested where rates are supposed to be going. But what happens is we're having these different changes in jobs and inflation and things like that beat expectations. So what you have is, because they're coming in so hot, the economy looks hot, and we're getting a lift recently in interest rates. But I have to pause for a second, really quick, because I have a friend. That's right. He just came back from preschool. What did you do today? What did you do today? Did you go to school?
Yeah.
Did you take a nap?
Yeah.
That sounds good. It's pretty fun when you get to take a nap.
Why that matches that?
Oh, why is that over there? They match. Yeah, he's looking at another screen. Pretty cool, huh? Say hi to everybody.
Hi.
Do you play soccer?
Yeah.
Guess what? We have another kid that plays soccer. So we have one that's running now, and we have another one that's playing soccer. Uh-oh. Anyways, we'll let you go over there and get a tissue. Wow. Next Tuesday, he turns 4, believe it or not. We've watched him grow before our eyes, right? Because we've been doing this now for nearly 2 years, and he was 2 years old when he started, and he'll be 4 years old next week. But anyways, let's get back to this Fed rate hike. So the Fed rate hike, what they're going to do is they're going to be increasing the federal funds rate, which is the short-term rate. That's not long-term rates. I want everybody to understand that. Just because they're raising this rate does not mean that rates will all of a sudden rise. Because guess what? We already have seen a rise in our interest rates, and yet they've pretty much done nothing other than wind down their mortgage-backed security purchases. We'll get into that in a second, but that's not really what's going, which is causing our mortgage rates to rise, the 30-year mortgage rates. The short-term rate is for like car loans. It affects car loans. It affects credit card debt. That's how it affects us. It's the small, shorter debt, and that's what happens when they raise the federal funds rate. And typically, this chart, you don't have to really look at it. I'm just going to tell you that when we analyze things, when the federal funds rate starts to increase, mortgage rates tend to go sideways. They don't necessarily all of a sudden go up. They don't all of a sudden go down either. But there have been times where they're raising the federal fund rates and the interest rates are going down. So it's not really, it doesn't predict higher rates because they're raising the short-term rates. So we have to educate our buyers and sellers as to what that means when they change the federal funds rate. And then, I have another visitor. Here it is. It is, who's this?
Athena.
Athena Rose. How are we doing?
Good.
That's good. You're done with school for the week?
Yes.
You're gonna have fun this week?
Yes.
Weekend? What are we doing this weekend?
We
You have a soccer camp.
I have a
scrimmage.
Scrimmage.
It's not real season, hasn't begun, but we have a scrimmage
going
tomorrow.
to
11v11. Right on. We'll have some fun this weekend.
We're going to church.
Cool.
Ziki's birthday's on the 15th.
Yes. Awesome.
That's
Well,
all.
thank you. And then, oh my gosh.
Go Rams!
Hello.
Hello.
This is Alana. Alana?
Yeah.
What are we doing this weekend?
Well, I work and then we're watching the Super Bowl.
Ha!
Go Rams.
That's right. Yeah, go Rams. Who's the biggest Super Rams fan you know?
Zeke. Just kidding.
Pappy!
Pappy, definitely. A ballpark pizza team. He has a flag that he likes to wear right around his, like a cape.
He has a whole, I think, wall.
Yeah, he has a whole wall devoted to the
It
Rams.
says whose house?
Whose
Rams'
house?
house.
That's right, Rams' house. All righty, getting back to it. So we talked about Fed tapering. We talked about the mortgage-backed security purchases, and we talked about the short-term rate. Sorry, getting right back into things, kind of hard, but here we go. So the Fed has been tapering, and they've been tapering since the end of last year. So they have been doing mortgage-backed security purchases. So all of these government backed loans, pretty much they're guaranteeing these loans. The government says, yeah, we guarantee them. They're all packaged up and then they're sold off in as mortgage-backed securities. Well, the Federal Reserve was buying these at a very, very strong pace, $40 billion per month. And now they brought it down from 40 down to 20 this month. And now it'll be down to 0 as of next month. And then they'll not be purchasing any more mortgage-backed securities. Now, they still are playing. So what a lot of people don't understand is that if somebody sells their house or all these payments that they get in, they get all this money, right? All this money. What do they do with this money that they get back after somebody sells their house, that they own that mortgage-backed security, but then they sell their house, now they get this money back. What do they do with that money? They reinvest it. They've been reinvested right back into mortgage-backed securities. And they've been doing it at the tune of, it's varied between 50 billion to 75 billion. Average is right around $60 billion per month. So before, prior to them unwinding their purchases, they were actually playing as hard as $100 billion per month in mortgage-backed securities. So they were pretty much funding a big chunk of that secondary market. And then what happened was, now they brought that down to 0. Now they announced at their meeting in December that Wall Street Journal came out with an article that came out on Tuesday, the first Tuesday of this year in January, and a lot of people knew about this article even the day before. And as of Monday, the first day of the year, all of a sudden we saw the 10-year Treasury go up and mortgages go up. And that's because they announced that they're going to want to drain their balance sheet. So they've been accumulating at $40 billion per month, a ton of mortgage-backed securities. And what they've said is now they want to unwind that and they want to drain it. Well, let me take you back to 2013. In 2013, they announced that they were going to taper the first time mortgage-backed securities, and then there was this taper tantrum, and rates rose really, really fast. Well, then in 2014, they actually started doing that unwinding and bringing it down to zero, like they are with the mortgage-backed security new purchases right now. But then they started to drain their balance sheets. They started to drain it like 3 years later. They waited 3 years. I thought, and a lot of people thought, that they were going to wait like a year or somewhere down the road to begin to drain it. Well, what they said in their meeting minutes when they met back in December was that they want to do it now. And now meaning like it could come as early as June is what a lot of people say. I think it's going to come as early as April. It doesn't matter. They're going to do it right now. They're not waiting 3 years. And they're going to take that $60 billion and they're going to bring it down to $50 billion and then $40 billion. So they're going to start to unwind that. And when they unwind it, they're going to drain how much they have of mortgage-backed securities. Well, because last time it took them a few years to get there, and this time it's happening instantly. So they are raising the short-term rate as of next month. Their mortgage-backed security new purchases are coming down to zero, and they're going to start to drain their balance sheets. It's doing so much all at once. It's like what I said. It's they're in this hurry-up offense. And they're trying to thread the needle to try to tamp down inflation, but also not cause too many ripple effects in the economy. And there's been a lot of people, AKA Wall Street investors, that have been talking about a recession. And this recessions don't happen in a snap. I want everybody to understand that. Instead, it evolves over time. And compliments of Logan Motoshami, he has this where there are 6 yellow flags that need to go up in order for him to call a recession. And then I went backward some time and I said, that is a model I totally believe in. So I'm going to adopt Logan's recessionary model. And here's the recessionary flags that he is referring to that I'm following as well. The Fed raises the short-term rate. That's a flag, and that happens next month. Typically, when they start to raise it, within a certain amount of time, there tends to be a recession when they raise the federal funds rate. So this is just one of the 6 flags. A second flag is the inverted yield curve. Just know that this is something that I'll be watching. I'll let you know when it's getting tighter. It is getting tighter and closer, but there's still there's room for it to go. But so we don't see an inverted yield curve yet. So pretty much the only one that will be lit so far is the Fed raises the short-term rate, and that is in the month of March. How about unemployment rate drops below 4%? This is my threshold. It might be a little bit different for some people, but after looking at everything, I think it's below 4%. Once we get below 4%, which is going to happen probably next month. It actually was at 3.9% a month ago and then was back to 4% a couple months ago, and then it was at 4% last month. And the reason that it was at 4% is because more people came back to the workforce. So it's right there. Pretty soon, this will be the second recessionary flag that comes up because the unemployment rate is going to get too low. And then a third one is housing starts fall 2 quarters straight. Now, typically, when rates start to rise too much, this can affect housing starts, but you have to watch this happen for 2 quarters straight. We're not anywhere near that yet, so that's not a recessionary flag we'll see anytime soon. Leading economic indicators fall for 6 months straight. This is different for different people, but mine's about 6 months, and I don't think that this is going to happen anytime soon, but it's something that we will be watching. Retail sales dropping and supplies spike due to weaker demand. Well, we're having a real hard time with supplies spiking, and we don't see retail sales dropping yet. This is something that they would like to see. They'd like to see that this sector cools down a little bit because it's been running a little bit too hot, the retail sales side. So right now we have 0 of the 6 flags. We're going to get 2 out of the 6. And that is going to be unemployment drives down too low and the federal funds rate gets changed next month. So you could see right now, not enough flags to even be talking really about a recession. Yet Wall Street brings it up. And why? Because Daddy Warbucks, the federal government, isn't propping up their Wall Street investments. And that's kind of when things get a little more crazy at Wall Street, they want them to help prop up Wall Street like they have been for the last couple of years since we went into this pandemic. So And I want everybody also to know, here in Southern California specifically, only 2 out of the 6 last recessions did we have a recession that affected the housing market. And those were 2 recessions where we had a major change in unemployment. And so that's 4 out of the 6, meaning that we actually had property values rise, not fall, but rise during that recession. So you have to have an unemployment-driven recession in order for us to have something that really affects housing, especially right now, the way how strong the housing market is today. So and I don't see that happening. I see a recession economically that we could have down the road, not anytime this year, not anytime soon, but when we eventually do, that it won't really affect employment that much, but it will just be where our market is slowing down a little bit, our economy is slowing down. So I see interest rates ranging between 3.25% and 4%. We're right at, and this is with 1 point and 20% down. We're right there because we're right at about 3.75% with 1.20% down. And we're right there. We're getting towards the upper end of where I think rates will go, but I think we're gonna have a hard time busting above 4%. I would like actually to see about 4.125%. And then at that point, it's going to slow down the market. Or if we just at least stay here, we're going to slow down the market enough where we will start to see a change in our marketplace and more homes coming on the market. And know that the lower the interest rate, the more insane the housing market. And even at 4%, we still have a seller's market. It just won't be as insane. I've actually heard from a lot of different agents out there, but this is what, based upon everything that I looked at in the past and the way that we behaved before, as interest rates rise, we get more product. So understand that. And you know what? I understand that there is a lot of uncertainty out there. So for me to say for sure where interest rates are going to go, I cannot do that because there's way too much uncertainty that's out there. Ukraine right now is they've talked about that Russia could go into Ukraine and a war could begin within the next week, is what U.S. intelligence is now saying. So if that actually happens, what we're seeing today is we actually saw the 10-year Treasury come down a little bit, and we can see mortgage rates come down a little bit because of this conflict that's in the Ukraine. So things around the world can affect our housing market. So, oh, by the way, before I get to the housing numbers, because I'm not done yet, I still have to get into the housing numbers, but I wanted to thank our sponsor, Kevin Buddy at Monarch Coast Financial. He once again is sponsoring the housing debrief. And as you know, he deals with more than one kind of borrower, and there's more than one kind of loan. And he deals with everything from full documentation loans to alternative documentation loans, investor financing, and even private money loans. He's been doing this forever. He has loads and loads of experience. He's been doing this since 1976. He's been helping out the real estate community, very, very involved in the real estate community. And you can too have Kevin Buddy, my buddy, your buddy, Kevin Buddy at Monarch Coast Financial help you out as well. You can reach him at 949-422-2075. That's 949-422-2075. Now, thank you for our sponsorship. Back to the program and the housing market. And I know that this particular housing debrief might be a little longer, but there's been the last time I did one of these was the start of November. So you have to understand there's been a lot that has transpired, and I want to bring everybody up to speed before we launch out and bring this thing down to about a half hour. But the housing market has been nothing short of insane. And we've all felt it. And it really does have to do with supply and demand on why the housing market is as insane as it is today. The housing inventory has been shrinking. And they used to call it a housing crisis, but not anymore a supply crisis. I call it a supply catastrophe because we got down to catastrophic levels. I thought last year was ridiculous with the number of homes that we reached, and yet we reached even lower numbers this year for SoCal as a whole. LA, Orange County, and San Diego hit all-time record low levels as of January 1st of this year. And it was just absolutely ridiculous. So there's really nothing in the tank as far as inventory is concerned. So we've dwindled it down so where there's so little. It's like one of those situations where there's just fumes in the gas tank and you've got your fingers crossed hoping that you'll make it to the gas station. And this is not just a SoCal phenomenon. This is a national phenomenon. This is from Altos Research. And if you see this, on April 30th of last year, there was 307,000 homes, and it was an all-time low for our inventory. And then if you look to the right, where we are currently, we're at 255,976. So last year was bad. This year is even lower. 255,976, and it really hasn't hit a bottom, and that's because the rest of the country is still in winter. It's going to hit a bottom sometime in February, but the reason it takes a little bit longer for the rest of the country, they're all they're dealing with winter storms, and yet we have 90-degree weather this week. But so this can even go a little bit lower. This is a really low level. I can't express how low this is. We need to be way higher than where we are today, and at 255,000, this just is not cutting it. So there is a seasonality to the market. There are 5 seasons. Spring is the best. The number one month for homes coming on the market for all markets is the month of May. And that's because that's when families want to place their home on the market and then close during the summer. So they place their home on the market in May, closing during the summer when the kids are out of school. Everything revolves around the kids. Summer is second best, but remember, by the time you get to the end of July, you're getting too close to the start of school. So that's where it starts to slow a bit. And then you get to autumn. That's when the kids are back in school. Holidays, the slowest time of the year. And then there's winter. Winter is where we are right now. This is where the inventory is extremely flat. That there are not we're having a really hard time building our inventory, even though we're placing more homes on the market, because demand is so hot always during this time of the year. It always outpaces the number of homes coming on the market. I shouldn't say always, but that is the majority of the time. Cyclically, that is what happens. And so demand continues to go up while the inventory is flat. So the market gets hotter and hotter because the inventory is staying the same, but the demand is going up. And we get to Super Bowl and everybody out there screams, yes, this is the best time to come on the market. But a lot of homeowners still don't come on the market. When do they come on the market? Spring. So not winter. Winter is all the way until the middle or latter half of March. So it's still winter for another month out there. And SoCal supply, as you can see, this is where we are right here. Very, very low. All-time low levels for Southern California. And this is where it was on February 3rd. I do this every 2 weeks, but then I'll give you an update as to where we are today from last week to this week. And February 3rd, we were at 12,274. That was up 1%, or just a measly 77 homes net difference. So that's everything come on the marketplace in escrow. What we're left with is just 77 additional homes in a 2-week period of time for all of Southern California, with the millions of homeowners out there. The lowest level ever was on January 1st with 10,853. I can throw out there, that is a really low number. You have to understand that Orange County got down to 954 homes on the market. San Diego County got down to 1,250 homes on the market. That was an all-time record. And LA County got down to 4,500 homes on the market. Not even close to where they should be. So last year at this time, we were at 16,737. That's 36% higher than where we are today. And last year, what everybody was complaining about was not enough homes on the market, because the 3-year average prior to COVID, that's 2017 to 2019, was actually 34,622. That's 182% higher than where we are today. So you can see that is a lot more homes. That's above the green line. You can see that's actually above where that green line is. That's where we should be on average, right around there. And instead, we're so far below that. So today is at 12,234. So basically no change. Actually, if you look at it, it's down like 35 homes or something like that. So that's ridiculous. So, or 40 homes. That's because every home that's coming on the market is being slammed right into escrow. Even though values are up, not values are up, even though interest rates are up, we're still getting homes being slammed into escrow. And the inventory, where it will go right now, is flat until we get to around April, and then it will rise from there. And rising from there is still going to be lower than where we were last year. Unless we have interest rates that hold where they are today or go a little bit higher. And what we'll eventually do, and by the way, this is where we will peak. We will peak in the summer between July and the second half of August. But if interest rates continue to go up, we could actually see the number of homes come on the market, and they will stay on the market. So some of them will stick. Anybody that overprices as rates get too high will actually stay in the market. They will stagnate and they'll have to reduce their asking price in order to sell. And that's what typically happens from what I've seen before in 2013 and 2018, the last two times interest rates rose at least 1%, which is what they're kind of like doing right now. And then we can go even higher. So we have more homes on the market than last year at this time. So where are all the homes? This is a problem that is going to put a monkey wrench in my theory of inventory rising a lot because of the fact that there are not a lot of homes in the market. And I'll tell you what's happened in 2020 and 2021. For all of Southern California, we were missing 9% of the number of homes that typically came on the market prior to COVID. So that's 55,000 missing for sale signs. That's a chunk. But in January, last month, we were missing 20% or 4,500 homes in a single month. And that's, remember, that other one that's 24 months. In 1 month, we did 4,500 homes that were missing on the market. You could partially say that that is because of Omicron, but there are other things at play. As a matter of fact, it's the most missing for sale signs since May of 2020. That was the start of the pandemic, where March was the worst, then April was second worst, and then May was the third worst missing for sale signs. That was the story. Everybody thought that this market was going to tank when we got in the pandemic, but not necessarily. Because we weren't placing enough homes on the market. So you have to have more supply for home values to even start to come down. So where will I go? This is the number one reason why people are not placing their homes on the market. Because if they are a seller, they place their home on the market and they place their home instantaneously into escrow, then it's, where do I move? Where am I going to go? Because they become a buyer and they know how hard it is to purchase something right now. They've heard about it. What they don't want to become is homeless. They don't want to have to go move into a motel or a hotel until they find someplace. Or secondly, they don't want to have to move in with the in-laws, mom and dad, that type of thing, grandma, grandpa, that type of thing. So it requires like a double move. It's a major headache. And so there's a lot of people that are saying, yeah, not for me yet. And there's other factors into it. One of them being that rising home prices keeps people in their seats. They go, yeah, values are going up anyways right now. I don't really have to necessarily place my home on the market. That with the combination of, yeah, there's nothing for me to find anyways. But then also homeowners have these current really low rates. And with rising mortgage rates, they're saying, well, I already have this great rate. I don't want to sell and then have a higher rate. So that's what the story is out there. There are solutions to this. There's a 10-1 ARM that you can do, and nobody's doing ARMs right now. 90% of all mortgages that people are doing are fixed rate mortgages. So, but I think that there's going to be more people tapping into 10-1 ARMs because I can't guarantee, but I'm fairly certain that within 10 years, you'll be able to refinance your rate down the road to a 30-year fixed rate if you plan on living in your home for longer than 10 years, which a lot of people are, like myself. In my situation, I'm not planning on moving, but if I was looking at it right now, maybe I would do that 10-1 ARM and then refinance out of it when rates go down lower. Because if we have a recession somewhere down the road, a few years down the road, that will probably bring down interest rates and then you can refinance at that time. So that is a solution. A lot of people have these really low rates right now, but they don't want to move. This is psychologically what they're doing, and this is what we have to explain to them as an industry because they are prisoners of their own home because they have such great loans, they don't want to move. And that's because it's not necessarily that they're in love with their home, they're in love with their loan. They love how their payment on a monthly basis, they're locked in at 2.5% or these low rates. I heard one person say that their rate was better than where the 10-year treasury was at, which means they'd have to be at 2%. So it just shows you that this will keep people in their seats because rates are higher right now. So if they were to turn around and sell and have to get something else, they would look at a higher rate. So SoCal demand has been like this. This doesn't even necessarily have to be an open house. I've heard from a lot of agents that there's a line to get in, even just to see the house. And it's like, please take a number. And what was fueling this before were these 17 record low rates, but now we have these higher rates, yet we still have these lines. What's going on? It's called the scarcity of goods, scarcity of homes is driving prices right now. And we had that problem at the beginning of the pandemic when you couldn't find toilet paper anywhere. So you would actually pay a premium for toilet paper or buy it off of somebody. I'll buy you that gigantic Costco roll off of you for $20. I mean, that's where we were at. People would pay a premium for teepee. And just like right now, they'll pay a premium for cars because there's not enough cars out there. And in order to buy a car right now, you have to pay a premium between a few thousand to $10,000 are these premiums. They actually call these market adjustment fees, and they're on the sticker where there's the sticker, and then below that MSRP is a market adjustment fee for COVID and the current supply chain issue. As a result, everything is still selling for over asking price. It's like an auction-like atmosphere. That's what the most recent report that you can sign up for talks about. In December alone, this is from California Association of Realtors, 58% of all homes that closed sold above their asking price. And I know pretty much in all markets in Southern California, it's between 56 and 62% of all closed homes in the month of January sold above their asking prices. And it's only going to go up from there because, and you could see this goes up and down. It was as high as 70% plus during May, June, July, and then it came down. That's because that's seasonality. Now the season is where it starts to increase, and we're going to start to get these prints that are even higher. In March, the number of closings that will sell above their asking price will probably stretch to 65 or maybe even hit 70% that fast. And the median time on market for everything that closed in the month of December in California is 12 days. And 101.2% is the sales to list price ratio for across the state, which means that 1.2% above the list price is on average what is happening out there in the month of December. And demand is a snapshot of the last 30 days worth of escrow activity. February 3rd, it was at 13,913. It zoomed up 21% or 2,459 pending sales. And last year at this time, we were at 16,816. That was 21% higher than where we were last year. You can't really compare year over year until we get to March. But I still think once we even get to March, it's still going to be below where we were last year. And that's because of the late spring we had for 2020. It kept on going through the start of our year last year. And the 3-year average prior to COVID is 14,041, which is actually 1% higher than where we are today. That just illustrates that there aren't enough homes coming on the market that they would have gone into escrow had more homes come on the market, but they're not coming on. So we have a muted number of escrows out there. Today, we're at 14,869. So it actually went up 7%. So where are we going from here? We will continue to go up. We're actually going to beat where it was in 2020 because that was the beginning of COVID. So it's going to continue to go up, but it's going to hang right below last year's levels. So we're slightly less than last year's demand readings. That's recent escrow activity of my demand readings the last 30 days. And then we'll peak right here in spring between April and the middle of May. In middle of April to the end of May. And then, or we can have interest rates that continue, they stay where they're at, or they can actually rise a little bit from here. If they rise a little bit from here, we can actually see the demand curve flatten a little bit. And I don't want you to think that I'm getting excited about that there are fewer escrows, because that means that there are fewer transactions for agents out there. But what I am rooting for is for this market to change. It's way too hot. And the only way we can do that right now is either values get up to a point where people walk away, or we have interest rates come up enough where it slows down demand a little bit, allowing for people that overprice their homes to sit and accumulate so we have more inventory. That is what we kind of need at this point. And so how fast is this market moving? It's ferociously fast, 26 days. And this is, it went down 6 days in a 2-week period of time. So it was 32 days, 2 weeks prior. Now it's at 26 days. On April 1st was the lowest ever of last year, 23 days. We're very close to the lowest, hottest point, which was last year. It typically happens right around between March and the start of April. Last year was at 30 days at this time. So we're almost close to last year, but just a little bit hotter. And the 3-year average is 76 days. You can see a lot hotter on average prior to COVID. And today we're at 25 days. So it's going down a little bit, notch by notch. This is week by week. Probably get to 24 next week, and then we're going to make our way to 23 or 22. So we'll be hotter than where we were last year, and we'll set a new record based if the market does not, if we don't see rates continue to rise from where they're at today. Because Los Angeles is actually at 36 days. It actually came down 1 day in the last week. Orange County's at 21 days. It went down 2 days in the last week. Riverside's at 27 days, down 2 days in the last week. San Bernardino's at 33 days, down 1. And San Diego's at 21 days, down 2. So it is extremely hot out there. And the expected market time, this is between the blue and the black, is a slight seller's market. Still a seller's market, but still just slight, where we don't have a lot of appreciation, but we do have values. We don't have a lot of values going up, but we do have sellers calling more of the shots. But below that blue line is where it is a hot seller's market. But last year I had to create something new, and that's below 40 days, because we've been there since July of 2020, where below 40 is considered insane. That is my hot, now insane, below 40. And that's where we are. And we're diving down lower, which we're becoming more insane. And this is where it'll continue to dive until we get to around April 1st, and then it will start to rise from there. But if we have rates that continue to rise a little bit from here, I'm not hoping for them to like jump all the way up towards 5%, but go up a little bit from here, then we will see that the market times will be flat. And then once we get to April, we'll actually start to increase. So the market, it slows down just a bit so we can actually catch our breath. So home values, I know, based upon all the metrics right now that I'm seeing, I don't have to read anything. I don't have to read any news articles or anything from the media or anything out there. I know for a fact that home values are surging right now. And people are asking me, so Stephen, when do you see a top? I look at everything right now, and I can't wait to talk about there being some sort of a shift in the marketplace, because that's kind of what we need. I've been talking about that. But I really don't see yet anything. I don't see a crack in the market, nothing. So, but when I do, I'm sure you guys are going to hear it first. You'll see it in my reports. Oftentimes you're going to see it before it in the numbers, before it happens out in the marketplace, because it's such a small change, but it is a trend. I will actually see it, because it moves at a snail's pace. I want everybody to understand that the market shifts at a snail's pace. It's really, really a slow transition. It does not happen in a snap of a finger. So how will 2022 play out? Well, that's the crystal ball. But the big thing is this. I don't quite know where things are completely going to go. I don't know how high rates are going to go. If I said that I knew where they're going to go, because they kind of go in levels, and the Fed changed things, so my level increased. When they changed things, I had to recalibrate where the top was, because I did have 3.5%. Now I have 4% with 1.20% down. Can they go higher? Absolutely. There's other shoes that can drop where things can get out of control, but nothing that I'm seeing in the numbers shows that it'll go that much higher than where we are at 4% or higher than that. However, it can happen. Something can happen. I just don't see it in the numbers yet. I don't project it's going to happen, but can it happen? Absolutely, it can happen. So we just don't know. If you want a copy of this, you have to be a subscriber to the Housing Report. Any of the 5 Southern California housing reports. And where do you go to subscribe? Reportsonhousing.com. You go there, you subscribe, and it's $15 per month or $150 per year, and you get a month free if you sign up utilizing the coupon code February. By the way, that's a funky month. I have a hard time spelling. It's February. So just go there, put in this coupon code, you'll get a free month. And that's all I have. But I can, let's see, I will go back into my studio. Where did you go, studio? Oh, there you are. I couldn't find myself. So I wondered if there were any questions. They would pay premium TP for the PPL. Wow, Jamie, that's pretty hilarious. No, not that it will happen, but if government lowered taxes, property, etc., do you think more people would consider moving, thus improving inventory? The problem isn't that we do need more product, right? We need more homeowners to come on the market. I don't think there's anything that's going to rush them to all of a sudden place their homes on the market. What I do see happening is the market slows down. We need demand to slow, not induce people to place their homes on the market, because that's not going to work. We need demand to slow down. So all these people that are placing their homes on the market and are ahead of their skis, overpricing, they can't get their price. And then they'll have to come down in value. They'll have to reduce their price. That will happen in time. I do want you to know that will happen in time if the interest rates stay where they're at or go higher. And so that's the only way that we can really accumulate inventory. It's not all the people that were supposed to go into foreclosure or the people in forbearance coming out were all supposed to flood the market. That's not happened. There's not been a wave of people with the ending of these various, Omicron and Delta and all that stuff. So I'll give everybody a copy. I'll answer the questions that you have in the chat afterwards, so I'll put them right in there. I'll answer them directly. But I invite you to subscribe so that you can get more of this great information. And please, in the comment section, put any questions that you have, and I'll be more than happy to answer, like I said. And please click the like button and subscribe at youtube.com/reportsonhousing. Thank you so much, and we will see you next week. Have a fantastic week.